Welcome to the deep dive. Today we are strapping in to examine what is really the foundational text of successful investment.
hmm
It's not just a book, it's more like a blueprint for financial sanity.
That's a good way to put it.
We are deep diving into Benjamin Graham's classic, The Intelligent Investor.
The essential one.
And we're looking at the version with the updates from Jason Zweig, which is crucial. And it carries what is, arguably the most powerful stamp of approval in all of finance.
We're talking about Buffett.
Of course, Warren Buffett's assertion that this is, and I'm quoting here, by far the best book on investing ever written.
And that endorsement, it just sets the stage perfectly.
It has to, right?
Yeah, because if the greatest investor of our time says this is the best, we know exactly what we're looking for.
And it's not what most people think.
Exactly. Our mission today, it's not about hunting down the next 10-bagger stock or anything like that.
No hot tips here.
It's about building a sound intellectual framework, yes, but, and this is the crucial part, it's about understanding the emotional architecture you need to actually support it.
Absolutely. Buffett really stressed that. He said, success isn't about brilliance or, complex math. It's about your ability to keep your own emotions.
Fear and greed.
Fear and greed, exactly, from corroding that framework.
Yeah, that's the word he used, corroding. It just eats away at it.
Which is why, for you, the listener, this deep dive is, it's a massive shortcut.
For sure.
You can become truly well-informed, not by trying to predict the utterly unpredictable market,
Which is a fool's game.
but by learning how to predict and, crucially, control yourself.
And Graham kicks off the entire book with an anecdote that it beautifully illustrates the danger of exactly that, of getting caught up in things, the danger of optimism.
Oh, this is a great one.
It's the perfect historical snapshot of human nature right before a major, major crash. I'm talking about the saga of John J. Raskob in 1929.
Okay, let's unpack this moment in history because it's so telling. Raskob wasn't just some nobody.
No, he was a titan. A General Motors executive, the Democratic Party chairman, a major public figure.
And the country was just running on pure euphoria, the roaring 20s.
Off-the-charts optimism.
So in that environment, what did Raskob promise the average American? He wrote this piece in the Ladies' Home Journal, of all places.
Which tells you how mainstream this idea was becoming. The title is just perfect for the era. Everybody ought to be rich.
You can't get more direct than that.
His premise was this simple, really accessible formula. He said, if you just saved $15 a month.
Just $15.
And you invested that consistently into common stocks, reinvesting all the dividends, you would, in 20 years, you'd possess an estate worth $80,000.
$80,000 in, 1949? That was a massive fortune.
A life-changing amount of money. And this whole promise was just rooted in this unsustainable optimism of the late 1920s. He was assuming stocks would just compound at 10% or more forever.
That is the ultimate, feel-good, optimistic forecast. It sells magazines. It fuels confidence.
And, as history shows,
it is utterly disconnected from reality. So when we actually crunched the numbers for the period right after his article from 1929 all the way through 1948, what was the reality?
Well, the crash hit almost immediately after he made that declaration. The timing couldn't have been worse.
So what happens to our hypothetical investor?
An investor who dutifully followed Raskob's exact plan, $15 a month, invested like clockwork into the stocks of the Dow Jones Industrial Average through those two tumultuous decades.
Which included the Great Depression and World War II.
Right. Not exactly smooth sailing. That investor would have ended up with a portfolio worth only about $8,500.
$8,500?
Right.
Versus the promised $80,000.
Yeah.
That is a jaw-dropping discrepancy. It's a failure of prediction by over 90%.
And that's the aha moment right there on page 1. Never, ever base your financial plan on someone else's optimistic forecast, no matter how famous or powerful they are.
But here's the twist, and this is where Graham's genius really comes in.
This is the deeper insight.
Even though Raskob's prediction was a catastrophic failure, the plan itself, the discipline of just consistently, regularly investing, that was a quiet success.
It was. That failure of $8,500 still yielded an 8% compounded annual return over those 20 years.
8% a year through the Great Depression.
Which is incredible. The actual growth was nowhere near the promised fortune, but, it beat inflation, and it certainly beat stuffing cash under a mattress.
So the lesson isn't that stocks are bad or that the market is rigged. The lesson is that the success came from the mechanical discipline, that idea of dollar cost averaging.
Just buying regularly through the thick markets and the terrifying thin ones.
And the failure came from relying on an emotional prediction. The investor's character was the key, not the forecast.
Exactly. And that is the perfect launchpad for our first segment, defining the intelligent investor and focusing on character over IQ.
Right.
Because Graham starts by insisting on a distinction that even in his time, he said, had become all but forgotten. And that's the difference between an investor and a speculator.
Let's really dig into that core distinction, because this is where the whole intellectual framework begins. In his seminal 1934 work, Security Analysis, Graham laid out a very precise definition. He didn't mince words at all.
No, he was crystal clear, and he defined it not by what you buy, not the asset class, but by the procedure you follow.
The process.
The process, he stated. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative.
And if you skip any one of those three elements,
You are speculating. End of story. Even if you're buying a blue chip stock like IBM or something, the label doesn't matter, the process does.
Okay, so let's break down the investor focus based on those three criteria. Starting with the first one, thorough analysis. What does that actually mean in practice?
It means you are doing the homework. You are studying the facts of the underlying business, its financial statements, its balance sheet, its competitive position, its management team, and then you're measuring those facts against established standards of value.
It sounds like detective work.
It is detective work. An investor knows why a stock is worth buying, completely independent of what the price quote says that day. They're thinking like a part owner of a private business they might hold forever.
The second point is safety of principal. I think a lot of people hear that and they confuse it with some kind of guarantee, which, just doesn't exist in the stock market.
That's a huge and crucial misunderstanding. Graham doesn't mean the government's going to bail you out. He means protection against loss under all normal or, reasonably likely conditions. It's a protection that has to be built into the price you pay.
The margin of safety.
The margin of safety. For example, buying a stock for $10 when you've analyzed the company and found it has $15 per share in cash and zero debt. That offers a strong safety of principle. The analysis provides the safety, not the market.
And finally, number 3, adequate return. And he's very specific about the word adequate. Not spectacular. Not a lottery win.
Right. A satisfactory rate. Something that meets the investor's carefully defined goals. Graham was very clear. You shouldn't be seeking these stratospheric returns because the effort to get them often involves either aggressive speculation or just an excessive amount of labor.
Which for the average person is just not worth the stress or the risk of making a major error.
Exactly.
Now let's contrast that whole mindset with the speculator focus.
The speculator operates almost entirely on the marketplace. Their standard of value is the price.
That's all that matters.
That's it. They buy a stock because they think somebody else will pay even more for it tomorrow or next week. It doesn't matter what the underlying business is doing.
They're betting on crowd behavior.
Precisely. They are addicted to the constant stream of stock quotes. Those quotes are their oxygen. They're betting on psychology, not on corporate fundamentals.
And this distinction leads us right to the core lesson of the entire book, which Zweig's commentary just hammers home again and again.
The crucial role of emotional discipline.
Yeah. Zweig argued that intelligence in this context has nothing to do with IQ or SAT scores. He said it is a trait more of the character than of the brain.
And we have two incredible high IQ failures to prove this point perfectly. We have to start with Sir Isaac Newton.
Oh, this story is just, it's incredible.
If raw brilliance could guarantee investment success, Newton would be the wealthiest man in history, no question.
The man who discovered gravity. He could calculate the motions of the heavenly bodies, as the saying goes, but not the madness of the people.
And he found that out the hard way.
Take us through his disastrous interaction with the South Sea Company back in 1720.
So Newton initially bought shares in the infamous South Sea Company, which was basically this highly speculative debt-for-shares scheme in 18th century England.
A bubble in the making.
A classic bubble. And he was highly intelligent. He sensed the frenzy was unsustainable, so he sold his shares early, and he netted a profit of £7,000.
Which was an enormous sum for the time.
Huge. Roughly equivalent to $3 million in modern purchasing power. He had already won the game.
But the mania, it was fueled by this irrational optimism and mass delusion, and it just kept going. The price kept climbing, and the roar of the crowd must have been deafening.
It was. And just a few months later, consumed by regret and FOMO, the fear of missing out, the feeling that he'd left money on the table, Newton jumped back in.
Oh, no.
He jumped back into the South Sea bubble right at its peak, paying a dramatically higher price.
Then we know what happened next.
The bubble inevitably burst, and he lost 20,000 pounds, a staggering failure. It wiped out his previous gains several times over.
The loss was so personally devastating that, for the rest of his life, he famously forbade anyone to speak the word South Sea in his presence.
Imagine that. Being Sir Isaac Newton, the man who mapped the universe, and realizing you were utterly incapable of controlling a simple primal impulse like greed or regret.
It's an incredibly humanizing and, frankly, terrifying story. But it's not just an 18th century problem, is it? It happened again in our lifetime with the failure of long-term capital management, LTCM, in 1998.
LTCM was the absolute pinnacle of intellectual arrogance.
Right.
This hedge fund wasn't run by street hustlers. It was run by a battalion of mathematicians, computer scientists, and 2 Nobel Prize-winning economists.
The smartest guys in the room.
Literally. Their models were mathematically flawless, or so they thought. They were based on complex historical data predicting that the spreads between similar bonds would eventually converge or, move back to their historical average.
So they were basically just betting that things would eventually return to normal. But why did all that brilliance fail so spectacularly?
It failed because they applied massive leverage. They were borrowing enormous sums of money, sometimes up to 100 to 1 against their own capital, to execute those bids.
100 to 1? That's insane.
It's unbelievable. So when the Russian debt default happened in 1998, it created this massive global liquidity crisis, a black swan event. And the bond spreads, instead of converging like the model said they would,
They did the opposite.
they moved wildly apart, something their historical model said was statistically impossible.
And with that much leverage, what was the result?
Because they had borrowed so heavily, a small, unexpected move in the market was magnified into a catastrophic portfolio-ending loss. They lost over $2 billion in a matter of weeks.
$2 billion.
Their mathematical brilliance gave them the confidence to take on unmanageable risk. It led to total complacency, and the sheer scale of their leverage nearly capsized the entire global financial system. The Fed had to orchestrate a massive bailout to stabilize things.
It just proves that IQ is a very, very poor substitute for prudence.
It's no substitute at all.
Which sets up Graham's critical framework for identifying these disastrous mistakes. He knew that some speculation is unavoidable, maybe even necessary, for things like innovation and venture capital.
Sure.
So he identified the 3 foremost ways that speculation becomes truly unintelligent and dangerous for the individual.
And the first rule is the most insidious. It's the most dangerous. 1, speculating while thinking you are investing.
The deadliest form of self-delusion. Can you give us a modern example of that?
A classic modern example is piling into a hot sector like, say, AI stocks or cannabis stocks a few years ago because of these huge future growth expectations, but without ever looking at the current earnings or the assets or the price you're paying.
Right.
You tell yourself, oh, I'm investing in the future, but you've done zero analysis. You have no safety margin. You are relying entirely on market sentiment to validate your purchase. You're speculating.
Okay, the second way he highlights is 2, speculating seriously instead of as a pastime when you lack the proper knowledge and skill for it.
This is for the person who decides they're going to be a day trader on the side.
Right, without quitting their day job.
Exactly. It often manifests in complex financial instruments. If you're devoting large chunks of your portfolio to highly leveraged options trading or buying derivatives you only halfway understand based on a YouTube tutorial, you are speculating seriously without the skill or the time commitment required to manage those risks. Graham insists that if you want to be an active speculator, you have to treat it like a serious second job.
And the third, which is the most dangerous, especially because of the leverage we just talked about with LTCM, 3, risking more money in speculation than you can afford to lose.
This is a fundamental violation of financial safety. And Graham provides a very actionable warning here. He says anyone operating on margin that's investing with borrowed money from their broker is, by definition, speculative.
Margin just accelerates everything.
Everything. If you borrow to buy stocks, a 10% market correction can wipe out 20 or 30% of your actual capital instantly. It turns what could be a temporary loss into a potentially permanent, irrecoverable disaster.
He also specifically warns against buying hot common stock issues. The IPO launches that everyone is buzzing about, calling it either speculation or just outright gambling.
And he notes that some complex strategies, like short selling on margin, where you borrow shares to sell them, hoping to buy them back cheaper, they carry unlimited loss potential if the stock moves against you.
Which is why margin must be avoided by the intelligent investor.
Absolutely. So if we accept that the gambling instinct is a fundamental part of human nature, which it is, and we can't just suppress it entirely, Graham offers a practical solution to manage it.
The mad money account.
The mad money account, the financial release valve.
I love this concept.
It's so smart. You allocate a tiny separate portion of your capital. Graham suggests a maximum of 10%, strictly for those speculative, high-risk, high-reward impulses.
This is the money you are emotionally prepared to lose completely.
100%. The function of this fund is just to satisfy that innate human desire for excitement without compromising the core financial security of your family.
And he has some crucial rules for this mad money fund. They're key to preventing that speculative mindset from, infecting the entire portfolio.
Rule number 1 is the most important. Never, ever add more money to this account just because your bets are paying off and profits are rolling in.
That's counterintuitive.
It is. He says if you have a massive win, that's actually the time to think about taking money out of the speculative fund, not doubling down. If you start feeding a winner, you were inviting the exact same arrogance that destroyed Sir Isaac Newton.
And rule number 2 ensures there's a psychological wall.
A firewall. Never mingle your speculative and investment operations, not in the same physical account and not in your thinking. The 90% investment portfolio is managed based on facts, valuation, and safety. The 10% speculative fund is managed on hope and a prayer. You have to keep those two worlds strictly, mentally, and physically separate to maintain the integrity of your core investment framework.
That structural discipline is really the only thing that can protect us when we move into the next segment, where we tackle stock market history and this illusion of predictability.
Yes.
This is where Graham really establishes that the market is not a rational calculator. It's an institution driven by pure emotion.
He paints that perfect picture of the market as a pendulum, just forever swinging between two irrational extremes.
Which are?
Unsustainable, wild optimism, which makes stocks dangerously expensive, and then unjustified, paralyzing pessimism, which makes them dirt cheap.
And the intelligent investor's role is, at least conceptually, very simple.
Conceptually, yes. Be the realist who is prepared to sell to the optimist when prices are manic, and to buy from the pessimist when panic reigns.
But that goes against the very grain of human psychology. It also goes against all the marketing of Wall Street.
Oh, completely. It forces us to confront what Graham called the pernicious maxim of Wall Street.
Which is?
The idea that stocks should be bought because they have gone up and sold because they have gone down.
Think about how absurd that is for a second.
It's madness. If you go grocery shopping, do you buy more of the item that just doubled in price?
Of course not. You look for what's on sale.
Exactly. But in the stock market, people chase rising prices and they dump their assets the moment they go on sale. It's a perfect illustration of the emotional, irrational herd behavior Graham was trying to neutralize.
This inherent irrationality is why Graham's, what he calls his law of diminishing returns regarding investment formulas is so important.
Right. Any mechanical formula for earning superior performance, he says, tends to be self-destructive. It fails for one of two main reasons.
What's the first one?
First, the formula might have just been based on statistical flukes that won't happen again. Think of these highly specific strategies like the famous Foolish Four idea that emerged years later, which was based on a very small slice of historical data. They often just stop working the moment they gain any widespread attention.
And the second reason is even simpler. It's just supply and demand of opportunity.
Exactly. If a formula works and everyone knows about it and everyone starts to apply it, that very popularity eliminates the opportunity. The market adjusts instantly. The edge is gone.
Like the January effect.
The January effect is the perfect example. The historical tendency for small-cap stocks to outperform at the start of the year. As soon as money managers and retail investors started trying to capitalize on it, the effect just weakened, the window closed, and the returns vanished.
So historical data serves not as a crystal ball to predict future prices,
No.
but as a stern, critical reminder of market volatility and human folly. It's a warning, not a guide.
Exactly. Graham's historical analysis, if you look at his tables, covering over a century of data, it proves that enormous volatility is just the norm. Major declines in the S&P 500 index, falls between 24 and 50%, happened regularly.
I mean, the collapse from 1969 to 1970, for instance.
Saw the S&P composite drop 36%. That was one of the largest drops since the depths of World War II.
And these collapses happen with alarming speed, which proves that trying to time the market is a fool's game. You can't do it.
You can't. Look at the specific market folly of 1961-62. The drop was terrifyingly fast. IBM, which was the epitome of the blue chip stock,
The bluest of the blue.
it fell from its high of $607 in December 1961 to $300 by June 1962.
That's a 50% loss in 6 months.
In half a year. But even more disastrously, the hot issues, the newly launched stocks of these small, fashionable enterprises, they lost 90% or more of their value.
And this was just 30 years after 1929.
It shows that the emotional pattern repeats itself exactly, regardless of the era.
So this all boils down to the core truth of the whole chapter. The future of security prices is never predictable.
And since you cannot predict the behavior of the markets, you have to learn to predict and control your own behavior.
That's the only variable you control.
It's the only one. And this is why Graham is entirely focused on creating a portfolio structure and a disciplined policy that is impervious to market noise, rather than trying to beat the market with superior knowledge.
Let's pivot now to the dramatic financial shift that Graham observed, because it really dictated his portfolio policy recommendations in the 1970s edition of the book.
Yes, the inversion of bond yields versus stock yields.
It's a profound change.
This contrast is absolutely vital to understand his thinking at the time. Look at the environment in 1949. The financial world is recovering from the Depression and the war.
So there's a lot of pessimism still.
A lot of pessimism. High-grade corporate bonds yielded a measly 2.66%. Meanwhile, representative common stocks yielded a very generous 6.82%.
So if you were just seeking income,
Stocks were clearly preferable. They paid you more than double the interest of a safe bond.
but then you fast forward to early 1972, when Graham was finalizing his revisions for the book, the entire yield dynamic had flipped on its head.
Completely inverted. This was largely due to rising interest rates driven by post-war economic expansion and, crucially, increasing inflation.
So what were the numbers then?
Highest-grade corporate bonds were now yielding 7.19%, while the dividend yield on industrial stocks had plummeted to only 2.76%.
Wow.
So in 23 years, bonds had gone from paying half of what stocks paid to paying more than twice as much.
And this forced Graham, the father of value investing, to a very rational, logical conclusion.
A conclusion that probably shocked a lot of his followers. Based purely on current income, he wrote, bond investment appears clearly preferable to stock investment.
That is a remarkable finding from a man famous for advocating stocks. It shows his utter commitment to analysis over any kind of traditional sentiment or dogma.
It demonstrates that your asset preference isn't some fixed philosophical position. It has to be a calculated contingent response to the prevailing yield environment.
So if bond yields are high and stock yields are low,
The intelligent investor has to rebalance towards bonds as long as they meet his criteria for safety. He even noted that if this inversion were guaranteed to last, the defensive investor would be wise to allocate 100% to bonds.
but the major counterargument, which you still hear constantly today, is inflation.
Right.
We have to address the standard argument that stocks are the only essential hedge against rising prices.
And Graham addresses this with a stern, data-driven reality check. He says stocks offer, at best, a half a hedge against inflation.
Half a hedge.
Yeah. We have a clear example from the period of 1966 to 1970. The cost of living index rose 22% during that time, but corporate earnings and stock prices actually declined.
So there's just no close time connection.
None. There is no direct one-to-one link between generalized inflationary conditions and the movement of common stock prices.
And he showed that high inflation is actually particularly destructive to stock returns.
The data since 1926 is damning on this. In years where inflation exceeded 6%, stocks performed terribly.
How terribly.
They lost money in 8 out of 14 of those high inflation years. They averaged a meager 2.6% return across that entire period.
So why is that? Why does high inflation hurt stocks so much?
Well, it creates enormous pressure. Companies can't raise their prices fast enough to cover their rising input costs, labor, materials, energy. And at the same time, consumers are cutting back on discretionary purchases, which squeezes profit margins from both ends.
And you mentioned earlier that inflation wasn't universally beneficial to corporations. Let's dive deeper into the drag that was caused by corporate debt.
This is a crucial mechanism that I think a lot of people overlook. Between 1950 and 1969, corporate debt in America expanded nearly fivefold.
Fivefold.
But during that same period, profits before taxes only slightly more than doubled.
So the debt was growing way faster than the profits. Why is that a problem?
Because as inflation and rising interest rates took hold in the late 60s and early 70s, corporations had to service that much larger debt load with dramatically higher interest payments.
Ah, so even if their revenues were nominally going up because of inflation, the rising cost of servicing all that debt was just eating the profit.
Precisely. You can see the severity in Graham's data. In 1950, net earnings before tax were equivalent to 30% of the total corporate debt. By 1969, because of the massive borrowing and high rates, net earnings were only 13.2% of the debt.
That shows a crushing, systematic burden on the corporate bottom line that inflation just could not overcome. The cost of financing expansion and operations hurt shareholders immensely.
Immensely.
Graham also looked at other traditional inflation alternatives that, failed his safety test.
He did. He pretty quickly dismissed gold. For U.S. citizens, who were largely prevented from holding gold directly until 1974, the price barely moved between 1935 and 1972.
What was the gain?
A 35% gain over nearly 40 years. But the holder received zero income return and had to pay storage costs. It was a terrible asset over that specific period.
What about real estate?
He also warned against direct real estate ownership, mainly due to its illiquidity, its lack of diversification for moderate investors, the price fluctuations, and the very high costs associated with management and transaction fees.
However, the commentary addresses the modern investor who wants inflation protection without these hassles.
Right. It introduces two vehicles that really satisfy Graham's criteria for diversification and safety today.
What's the first one?
The first modern tool is REITs, real estate investment trusts.
Okay.
These are basically companies that own and, importantly, collect rent from income-producing properties, office buildings, malls, apartments, you name it. And because they're legally required to distribute nearly all their taxable income to shareholders, they act a bit like high-yielding stocks.
And how did they address Graham's old critique of real estate?
Well, you buy them just like stocks, so they're liquid. And you can buy a diversified REIT fund, which eliminates Graham's primary concern that an individual investor can't safely manage just one or two physical properties.
So you get real estate exposure and anti-inflation benefits without the headache or the capital requirement of buying a whole office building.
Exactly.
And the second tool is critical for solving the problem of, your cash equivalents being eroded by inflation.
This is a big one. TIPS. Treasury Inflation-Protected Securities.
Right.
TIPS were first issued in 1997. They're U.S. government bonds, so they're safe from default. And they specifically guarantee that the principal's value won't be eroded by inflation.
How does that work?
The principal value of the bond automatically adjusts upward based on the Consumer Price Index, the CPI. If inflation rises, the principal of your bond rises right along with it.
That sounds like the ideal, safe, inflation-protected vehicle. Okay. But there's a crucial tax complexity that listeners need to understand about TIPS, right?
Absolutely. This is where it gets really interesting, and you have to be careful. The increase in the principal value of a TIP bond due to inflation, that protective adjustment, is considered taxable income by the IRS.
Even though you haven't received that cash yet.
Exactly. It's called phantom income.
So you're paying taxes today on money you won't actually see until the bond matures years from now, which reduces your effective return.
Precisely. If you hold TIPS in a standard brokerage account, you get hit with this annual tax bill. And so the commentary rightly suggests that the best place to hold TIPS is generally within a tax-deferred account, like an IRA or a 401k.
Because there, you don't pay taxes on the principal adjustment until you actually withdraw the funds years later.
And that's a perfect example of applying Graham's timeless logic-seeping safety, but adapting the specific tool to the realities of the modern tax code.
So if we agree that predicting prices is impossible, and that relying on hope leads to the Newton or the LTCM debacle, we have to fall back on structure.
That's all you have.
Which brings us logically to the fundamental question of segment 3, portfolio policy for the defensive investor.
This whole section begins with what I like to call the temperament test.
The temperament test?
Yeah. Graham insists that the rate of return you seek should depend directly on the intelligent effort you are willing to apply, not the degree of risk you are willing to bear.
So if you're lazy or just not interested in the analysis,
you have to accept a lower return. It's that simple.
And he separates investors into two main camps based on this commitment: defensive and enterprising.
The defensive or passive investor is seeking safety and, most importantly, freedom from bother. They want a minimal effort, set it and forget it strategy, and they accept that they will not try to outperform the market.
And the enterprise investor.
The enterprising or active investor is willing to devote significant time, effort, and care to the selection and timing of securities, hoping for superior results.
And the warning here is that your choice has to match your true character.
It's so important. The active path is physically and intellectually taxing. It requires constant reading and analysis, and most people who claim to be active simply don't do the work.
And the passive path?
The passive path, conversely, is emotionally demanding. It requires you to sit still and do nothing while the market is either soaring in a manic bubble or crashing in a panic. You have to choose the path you can psychologically stick with for decades.
Okay, so for the defensive investor, the entire framework is built around asset allocation, and it's encapsulated in Graham's famous 25%, 75% rule.
This is probably the most crucial guiding principle for portfolio stability in the entire book.
So what is it?
The investor should never have less than 25% and never more than 75% in common stocks, and the inverse of that should be held in high-grade bonds or cash equivalents.
So this provides a constant brake against emotional excess.
A governor on the engine, yeah.
The simplest, lowest effort version of this is the 50-50 division.
Right. It's the all-purpose program. It provides safety, it provides income, and it gives you participation and growth. But the structure requires mechanical rebalancing.
You don't just set it and walk away.
No. You implement a rule that forces you to act rationally when the market is acting irrationally.
Can you explain the mechanism of that mechanical rebalancing and why that restoration is so powerful?
Sure. Let's assume you start 50-50, stocks and bonds. You set a margin, say 5%. If the stock market soars, your stocks might grow to be 55% of your total portfolio value.
Okay.
To restore the balance back to 50-50, you are now forced to sell 1/11 of your stocks and move that cash into your stable bond fund.
And what if the market crashes?
Conversely, if the market crashes and your stocks fall to 45% of the portfolio, you are now forced to take 1/11 of your stable bond fund and buy stocks at depressed prices.
So the true value of this isn't necessarily about maximizing your returns, though it helps.
No, that's not the primary goal.
It's about psychological control.
Absolutely. Its primary value is that it restrains the investor from being drawn more heavily into common stocks as the market rises to more dangerous heights. It prevents the Newton mistake.
And when the market is crashing and everyone else is panicking.
The formula mandates that you must buy. It removes the emotional decision, and it enforces the courage necessary to be a counter-cyclical realist. It makes you buy low and sell high automatically.
Let's look at the bond component, focusing on safety and yield in that historical context of high rates back in 1972. What guidance did Graham offer for selecting the bond portion of the portfolio?
The defensive investor, he said, faces two main choices: taxable versus tax-free, and shorter versus longer maturities.
And the choice between taxable corporate bonds and tax-free municipals is just
Pure, simple arithmetic. It's based entirely on your personal income tax bracket.
So take us through the 1972 calculation he used as an example.
Okay, in 1972, high-grade corporate bonds were yielding 7.5%, and prime tax-free municipal bonds were yielding 5.3%. The calculation showed that anyone in a tax bracket over 30%, which, at the time, applied to married couples earning over $20,000 a year, would net more after taxes from the municipals.
Because 5.3% tax-free was mathematically greater than 7.5% minus a 30% tax hit.
Exactly. The lesson is timeless, even if the rates are different today. You must always compare after-tax yields.
And he had a rule about quality, right?
A strict rule. The defensive investor must stick to bonds rated in the top three categories: A, or A. Anything lower introduces credit risk, the risk that the company defaults, which is just unacceptable for the defensive bond component of your portfolio.
And even high-grade bonds carry another interest rate risk, which Graham's era demonstrated vividly.
Oh, indeed. Due to rising interest rates between 1964 and 1971, non-guaranteed bonds, even those rated very highly, suffered up to a 38% maximum decline in market price.
A 38% loss in your safe asset is substantial.
It's huge, and it shows that safety of principal is only assured if you hold the bond to maturity, or if you focus on shorter maturities, which are much less sensitive to interest rate fluctuations.
Graham also highlighted a unique investment he called a boon, a great boon, specifically for the small defensive investor.
U.S. savings bonds.
Right.
In that 1972 context, the Series E and H bonds offered a combination of advantages that was almost unparalleled for the small investor with modest bond holdings, say, under $10,000.
So what were those advantages?
First, they offered absolute assurance of principal and interest backed by the full faith and credit of the U.S. government. Second, they had a unique money-back option, meaning they were redeemable at cost after a short holding period, which completely protected the holder against market price decline.
So it's a liquid, safe, high-yielding asset that literally cannot drop in value.
It couldn't. Third, they offered a guaranteed 5% rate for 10 years, which was competitive at the time. And critically, they provided tax deferral on the interest earned for Series E bonds until maturity.
That combination of safety, liquidity, and tax options made them the ideal substitute for cash equivalents for the average person back then.
It was a perfect fit for the defensive investor's goals.
Finally, let's turn to Graham's extremely strong and very detailed case against preferred stocks for the individual investor. He famously called it an inherently bad investment form.
And his logic here is just irrefutable. It remains true today. The preferred stockholder sits in this weak, disadvantaged position, lacking the best attributes of both a bondholder and a common shareholder.
How so? In what way?
Well, they lack the legal claim of a bondholder because they're considered owners, not creditors. If the company struggles, bondholders get paid first before preferred stockholders see a single dime, so their principal safety is compromised.
And they also lack the upside.
They completely lack the profit possibilities of a common shareholder because their dividend is fixed. If the company triples its earnings, the common shareholder benefits wildly. The preferred holder just gets their fixed rate and nothing more.
It's a no-win scenario for the individual.
A total no-win? But the real driver of their poor value for private investors was the corporate tax structure at the time. This is the mechanism you really need to understand.
Okay, let's break it down.
This is the key. Corporations benefit heavily from owning preferred stock because, in 1972, the tax law stated that corporations only paid tax on 15% of the dividend they received from preferred stock. The other 85% was deductible.
So this created a massive institutional demand for preferred stocks.
A huge demand, which artificially inflated their price and depressed their yield for everyone else.
So a corporate tax loophole made them attractive to institutions, but terrible for individuals.
Precisely. The individual investor received no such tax break. They paid full ordinary income tax rates on that fixed dividend income, just as they would on bond interest.
So why on earth would an individual accept the inferior safety of a preferred stock without the legal protections of a bondholder when they receive the same unfavorable tax treatment as a bond?
You wouldn't. It makes no sense. Their safety is dependent on the company's ability and desire to pay dividends on its common stock. Once those common dividends are in danger, the preferred holder's position becomes incredibly precarious, and they don't have the strong legal standing of a creditor to fall back on.
This has been an incredibly detailed look at the intellectual and emotional foundation that Graham laid out. To summarize the essential lessons, investment success is not about market timing or brilliance,
Not at all.
but a cold-blooded weighing of the odds based on rigorous analysis and, crucially, a disciplined structure that you stick with.
And we have to conclude by returning to the central challenge, the one theme that weaves through every single chapter of this book.
Which is?
The fault, dear investor, is not in our stars and not in our stocks, but in ourselves. Graham's entire goal was never to make you a stock-picking genius. His goal was far more valuable than that. It was to guide you against the areas of possible substantial error and to help you adopt policies that you're temperamentally comfortable enough to stick with through every market cycle.
So what does this all mean for you, the listener, right now? Let's get that final provocative thought. The ultimate test derived from Graham's core philosophy of underlying business value. How do we test if our holdings truly qualify as intelligent investments?
Here is the ultimate test, and it's drawn from the deepest philosophy of the intelligent investor. You should only be willing to buy any stock if you would be comfortable owning the entire company on those terms. Even if the stock exchange shut down tomorrow and you had absolutely no way of knowing its daily share price for the next 5 years.
So if the market just vanished tomorrow and the only thing that mattered was the steady stream of earnings and the quality of the business itself, would you still feel good about owning what you own?
That is the measure of a truly intelligent investment. How much of your current portfolio passes that test of true long-term partnership in a business, regardless of the unpredictable, volatile, and ultimately mad behavior of Mr. Market? That question defines the true intelligent investor.